All right, let's dive into one of India's absolute titans of industry, Indian Oil Corporation. Now, you've seen their gas stations pretty much everywhere, right? But what's fascinating is that right now, this company is a total puzzle. It's a story of mind-blowing success on one hand and a massive, risky bet on the future on the other.
And that puzzle really starts with this number right here, 514.9%. I mean, just look at that. That's IOCL's year-on-year profit growth in its last quarter. It's an absolutely spectacular number that just screams, this is a must-buy stock.
So you see that and think, okay, simple decision, right? Well, not so fast, because hiding behind that incredible number is the story of two completely different companies that are somehow living under one roof. One is an absolute cash-printing machine right now, and the other is betting the entire farm on a very uncertain future.
Okay, so let's start with the good news. What in the world is driving these insane profits? Let's pop the hood and take a look at IOCL's profit-making engine.
So, the biggest reason for this profit explosion is something called gross refining margins, or GRM. The easiest way to think about this is it's the basic profit a refinery makes on every single barrel of oil it processes. And lately, for IOCL, that margin has been fantastic, mostly thanks to a really strong global market and getting their hands on cheaper crude oil.
And you know, it's not just one thing. All these factors have come together to create the perfect storm for profitability. IOCL isn't just a big company, it's a powerhouse. They refine more than a third of all the crude oil in the country. They have a retail network that no one else can touch. And get this, their refineries are running at over 100% capacity. They are literally squeezing every last drop of profit out of the system.
And wow, just look at the results. You really don't need a finance degree to understand this table. Net profit is up over 500%. But here's the number that really tells the story, the operating margin. It has almost tripled. That means their underlying business has just become dramatically more profitable. But, like we said, record profits are only half the story. So let's flip the coin. Let's look at the other side of IOCL's balance sheet, the side that tells a story not about the money they're making today, but about the money they're spending on tomorrow.
Get this. Every single year, IOCL is pouring 35,000 crore rupees into capital expenditures. And we're not just talking about routine maintenance here. The company is in the middle of a colossal, incredibly expensive plan to expand and completely reinvent itself.
And all that spending is really adding up. Right now, there's over 73,000 crores tied up in something called capital work in progress. Now, that's just a fancy accounting term for massive projects. Think brand new chemical plants, new refineries, that are currently just holes in the ground. They are consuming a ton of cash, but are not generating a single rupee in revenue yet.
So where's all this money coming from? Well, you guessed it, debt. The company's debt is absolutely ballooning. Projections show it's going to hit a staggering 1,47,000 crore rupees. That is a mind-boggling number, an all-time high for them, and a massive liability sitting on their balance sheet.
So the end result of all this spending and debt is that it's just eating up all the company's cash. Remember those record profits we were just talking about? Well, they're coming in the front door and going right back out the back door to pay for all these future projects. It creates a huge financial strain, and the company is stuck in a really delicate balancing act.
So you have to be asking yourself, why? Why take on all this debt, all this risk? Well, it's not just about getting bigger. It's because IOCL is trying to fundamentally transform itself for a world that's moving beyond oil.
And you can see this big shift right at the very top. The new chairman, his expertise isn't in oil, it's in petrochemicals. That's a huge signal. And his big signature initiative is called Project Sprint, and it's all about getting this state-owned giant ready for a new, more agile future. Project Sprint is basically their official roadmap for this whole transformation. You can think of it as a two-part attack. The first 5 pillars are all about making the old business, the refining and retail, more efficient and more customer-focused. But it's that 6th pillar, transition ready, that's where the real story is.
And believe me, this isn't just corporate jargon on a presentation slide. IOCL is putting serious money where its mouth is. We're talking a massive petrochemicals plant to protect them from swings in fuel prices. They're building India's largest green hydrogen facility, and they're rolling out thousands of EV charging stations. This is where all that money is going.
So, that brings us to the core dilemma. You've got this hugely profitable present on one side, and this hugely expensive future on the other. So how on earth does an investor decide what this company is actually worth? Well, let's start by comparing it to its peers. Right away, you can see IOCL is the giant in the room, way bigger than BPCL or HPCL. It also pays out a really attractive dividend to its shareholders. But look at that profit after tax margin. It shows they're actually a bit less efficient at turning sales into cold, hard profit compared to their rival BPCL. And this right here is the core conflict. On one hand, if you look at its massive earnings today, its price-to-earnings ratio is only around 7. A low PE like that suggests it's a total bargain. But if you look at it another way, using a model that tries to predict its future cash generation, you get the complete opposite story. That model suggests the stock is actually expensive, maybe overvalued by as much as 26%. So, which is it? Is it cheap or is it expensive? Well, the analyst's conclusion is basically that these two huge opposing forces, the great dividend that pulls investors in and the heavy spending that pushes future cash flow down, have pretty much balanced each other out perfectly. It's not cheap, it's not expensive, it's just about right.
So the final takeaway here isn't a simple buy or sell. For people who already own the stock, the thinking is it might be worth holding on, collecting that nice dividend, and riding the current momentum. But for new investors, the word of the day is caution. Chasing the stock at its current price is probably risky. A smarter strategy, they say, would be to wait for the market to dip and try to pick up shares at a lower price. Ultimately, everything boils down to this one huge question. Is IOCL successfully using the incredible profits it's making from the past to build its future? The answer to that is not only going to determine the fate of the company, but it could very well signal a whole new era for energy in India.